Hi, I'm Adam Khoo, and in this video I'm going to show you why majority of traders find it really difficult to be consistently profitable trading the financial markets. I get emails every day and people often ask me the same questions. Adam, why is it I'm not consistent in my trading profits? How can I get more consistent? It was easy when I started, it seemed easy, just click a button and make money. But the fact is, it's not easy to do it consistently, right? I always say it's easy to make money. What's difficult is holding on to that money, because most people lose that money just as easily. And again, people often ask me, what's wrong with me? Is it my bad luck? Is it I don't have what it takes? Is it because the markets have changed, right? The strategy doesn't work anymore. Am I using the wrong instruments? Should I be trading forex instead of stocks, or options instead of futures, right? Am I using the right strategy? Could you help me become more profitable consistently? The good news is yes. In fact, in the last 12 years, I have mentored and coached thousands of students to become consistently profitable. Many of my students have gone on to become professional traders, working in proprietary trading firms, becoming fund managers. And all I did was I taught them how to make minor adjustments to the way they trade, and that make all the difference. So what are these adjustments? So in this video, I have compiled the key lessons that hopefully you can learn and make these adjustments for yourself. So let's get started. Now, when I coach people to succeed, the first question I ask them is, tell me your stats. Tell me your statistics. In other words, over the last 50 to 100 trades, what is your exact win rate? I need to know your exact win rate right now, and at the same time, I need to know what is your risk to return ratio. In other words, if you take your average win divided by your average loss, what's that ratio? And some people can tell me, but most people will look at me and say, I've got no idea, right? Now, if you have got no idea where you are, I can't help you to get to where you want to go. So the first thing to understand is awareness is the first step to change. You must first be aware of how you're trading right now. The only way to do that is to keep a trading journal. The only way to succeed in trading is to treat it like a business. Right? You have to journal down every single thing about every trade you make. So in other words, for every trade you make, you have to put in the entry price, the exit price. What was the trading signal that you followed? What is the risk per trade you're trading with? Are you risking 1% a trade, 2% a trade? What is your average R loss? What is your average R win? And again, it must be done at least over 50 to 100 trades to get a good idea about what's happening. So some people say, but I've never done it, so should I start doing it now? I say, yes, start doing it now. And they say, but Adam, if I do 50 to 100 trades, I may lose a lot of money because I'm not making money right now. I say, fine, start with paper trading so you don't risk any real money. So at least paper trade 50 to 100 trades, get your statistics right. In order, then you'll know exactly how to make adjustments. Now, some people may ask me, if I do paper trading, it's not as real trading because there's no real money on the line. I may not take it seriously. So let me tell you what I make my students do. So when I get my students to paper trade initially, I say every time you have a loss, you do 50 push-ups, okay? If you end up the month negative, you run 5 miles, okay? Because most people don't like doing that, and that creates some kind of emotional pain. So you can do that as well. So the first thing is to know your statistics. And let me show you a few examples right now what I'm talking about. So for my live students in Singapore, when I mentor them, I get them to send me their trade journals at the end of every month so I can run through each trade that they do, and from there they make awareness to make adjustments. So here's an example of a typical month where I get all these trading journals sent to me by my students, and let me show you what the journal needs to have. So you need to have a trading journal, and every month you have to document again all the trades you make. So what's the entry date? You have to write it down. What's the direction? Are you going long or short in the market? What's the stock symbol or the forex pair if you're trading forex? What's the signal you're using, right? For example, what's the trading strategy, right? Is a piranha strategy, the bounce strategy? What's the entry price? What's your stop loss price? So the difference between the entry price and the stop loss price is 1R. Okay, so R represents the risk per share. And we always aim to make at least 2R or 2.5R in profit. Some of my students aim for 2.5R, some aim for 2R. Okay, so based on that, what is the target price to exit? What is the exact exit price? So if you exit at the target price, you make the R multiple of 2.5R or 2R. Okay, so what does this mean? So for those of you who are not familiar with the R concept, basically when you make a 1R result, that means it hit your stop loss, you lost 1R. So 1R represents your risk of your capital. So for example, if you're risking 1% per trade, okay, so a 1R loss means you lost 1%, okay, and if you make 2R, in this case you can see it's a 2R win, that means you made 2% gain on your capital. Does this make sense? All right. So this particular person, you can see it's his name is Brian, and for September he did really well. He did 5 trades and he had a 100% win rate. Okay, so again, you don't always get a 100% win rate. It happens that in September it was his month, right? And so his total R was 10.6R for that month. That's his result. So again, 10.6R is if he's risking 1% per trade, that's 10.6% return for that month, which is pretty good. If he's risking 2%, that's 20% return for that month. And he did 5 trades. So if you take 10.6 divided by 5, his average R per trade, known as the expected profit per trade, is 2.12R. And that's a pretty good month for him. And you can see that I had no comments because all his trades were valid, right? So he followed the rules and he did well. Here's another one by Kenneth, another one of my really great students. He's been around. I've been coaching him for over a year. Okay, and he had about 14R for that month of September. So you can see he did 14 trades and he used a combination of different strategies: capitulation, piranha, bounce, trading range, and these are all the different strategies that I teach. All right. Now you can see over here, that's his result, right? So it's a win, a win, a win, break even, win, loss, win, loss, win, loss, win, loss, win. Okay. And again, these are my comments. These were not valid, so he should have avoided taking those trades because he broke the rules. If he didn't break the rules, he would have avoided these losses, in fact. Okay. So he had 14.8R for the month out of 13 trades. So that's 1.14R per trade, or that's known as the expected profit per trade. His win rate is 62%. So you can see that even with just a 62% win rate, you get 14R a month, or 14% return for every 1% you risk. Okay. This is Arjun. Now, this is an example of why someone is not profitable yet. Okay, so if you look at his results, he did 7 trades. He ended the month negative 2.3R, so he lost 2% of his capital for that month. Now let's take a look at why. So if you take a look here, first of all, he didn't follow my rules very much, so I had a lot of comments that they were not valid trades. That's one thing. Next thing, notice, when he has a losing trade, he loses 1R, which is, yeah, that's what you're supposed to do. So 1R is when he hits your stop loss, you get out. The problem is for his winning trades, he only makes 0.19R, 0.48R, 1R, 0.01R. So notice that his average loss is 1R. His average win is less than 1R. So even though his win rate is 57% win rate, he's losing money because his average loss is more than his average win. Now compare that to Edmund over here. Okay. Now Edmund has a win rate of only 44%. He's got a lower win rate. He did 9 trades, but he had 5.7R in profit. He had a positive month. It's about 5.7% return for that month. If he's risking 1%, if he's risking 2%, it's double of that. Now, if you take a look at his trades, again, you can see he made some mistakes. I made a comment that he shouldn't have taken those trades. But again, that's beside the point. Now, the point is this. He had 1, 2, 3, 4. He had 4 wins and 4 losses and 1 break even. Okay, so his win rate is only 44%. But notice when he loses 1R. But when he wins 2.5 or 2R. So his risk to return ratio is positive, right? He's risking 1 to make 2 or 1 to make more than 2. So when you've got a good risk to return ratio, even with a low win rate, you are still making money. So that's the point. Now again, this is only 1 month. Now 1 month means nothing, right? Sometimes on a certain month you may have a bit of bad luck, right? And you could have more losses than wins. I've had that before myself, right? So you could have a low win rate. On certain months you could get lucky and get 80% win rate, like Brian had a 100% win rate. So that's a bit of luck. So you have to look at least 50 to 100 trades that you have done to get a good measure of your win rate. Because in the short term, it is a bit of luck, but in a large sample size, it is statistics. So what I do is I actually compile my students' trades as well as my own trades over many months and years, in fact, to get a good sample. So let me just show you. There we go. All right. So these are all the trades that I've compiled over the last 2.5 years. And if you're one of my students, you can request for this. I'll actually send it to you if you want to. Right. So for example, you can see that this is the bounce strategy. That's the piranha strategy, and that is the Bollinger Mean Reversion strategy. Again, these are the strategies that I teach in my courses. And you can see that, again, these are the monthly results and the number of trades taken. And again, there are certain months that could end up negative for that strategy. Okay, so you can see it's a negative month. Now, what we're interested in is, that's right, over a large number of trades. You can see for this strategy, known as the bounce, out of 500 trades. Now, again, this is a large enough sample, 500 trades. These are real life trades. My students got 315 R in profits, right? So if you divide that, that's an average of 0.63 R per trade. So every trade you do on average, you get 0.63 R or 0.63% return on your capital for each trade you do. Okay, the overall win rate of this strategy is 56%. And again, for this strategy, you can see it's a 54% win rate and 157 R of 324 trades. Down below, you can see the month-to-month data. Okay, for each month, for example, look at October, which was just over. You can see that this is for the bounce strategy. These are the winning trades. These are the losing trades. These are the break-even trades. And sometimes, I've mentioned before that although you have a stop loss there, but if the stock gaps down below the stop loss, you can lose more than 1 R. So in this case, this stock MGL gapped down, we had a 3.3 R loss, triple our normal loss. And it happens, right? It's a bit of bad luck, happens, right? But as long as you're consistent, you can see, for example, for the month of October, the win rate was 67%. Okay, and the average R win was 2.5 R, average loss was 1 R on average. So we're risking 1 to make 2. Now in September, you can see the win rate was 79%, right? And in August, it was a really bad month, right? Only a 9% win rate. You can see that 9% win rate, and you can see there were a lot more losses than wins, right? So again, the point I'm making is this: in a certain month, sometimes you can get more losses than wins, right? Certain month you can get more wins, but you're looking at an average over a large sample. So you have to do that to get your statistics right. And once you know your statistics, I can show you how to improve those statistics. So once you know your stats and you plot it on this graph, it becomes very clear why you're profitable or not profitable. So let's take a look at this graph. And this graph on the y-axis is the risk to return ratio that you get. So how do you calculate your risk to return ratio? Again, you take your average wins and divide them by your average losses. So for example, if your average wins are, say, $1,000 a trade. Okay, so on average, if you add up all your winning trades, the amount you win, divide by the number of trades, you win an average of $1,000 per trade. And you divide it by your average loss. So again, add up all your losses in terms of dollars, divided by number of trades. Say your average loss is $500. Okay, so in this case, what is your risk to return ratio? It is 1:2. Okay, so it is here, 1:2. So in other words, on average, for every $1 you risk, you're making $2. Again, if you use the R multiple concept, which I use, all right, every time I I have a losing trade, I always lose 1 R. Okay, so it's a predetermined loss because of my stop loss. And I always put a profit target at least 2 R above my entry price. So my risk to return ratio by default based on my trading system is always 1:2. But again, having said that, different traders have different styles. Like, you know, there are some traders where they risk 1 to make 1. So they'll be there, right? So, and there are some traders like they would risk 1 to make 5, for example. So it's a very far profit target, or they may follow the trend and exit only when they capture a very big trend. So that's fine, it's depending on your trading style. So that's risk to return ratio. The other thing to look at in terms of your statistics is what is your average win rate. And this is easy to calculate. So what you do is you take the number of wins that you have, divide by the total number of trades. And the total number of trades would be your winners plus your losers. Okay, so if you're winning, for example, out of 100 trades, you win 50 trades and lose 50 trades, your win rate is 50%. Right? Pretty easy to understand. Great. So once you know that, notice where you are in the zone. Right? Now, for me personally, my risk to return ratio is fixed at 1:2. And sometimes I may get 1:3 on certain strategies. So on average, my risk to return ratio is about 1:2.5, somewhere around there. Okay, and my average win rate is between 50 to 60%. Say 55%. Okay, so my win rate is about 55% there over a large sample of trades. Again, on certain months I may get a 70% win rate. On certain months I may get 40% win rate, but that's my average over many trades. So because of that, you can see where am I on this graph. Okay, so for me personally, I am here. So I'm in a profit zone. So that's how I'm confident I will always be profitable, right, over the months and years. Okay, so when I look at traders who are not profitable, there are a few reasons. Number one, it could be their risk to return ratio is usually lower than 1:2. Right? So for example, they are risking 1 to make 1. Now, if you risk 1 to make 1, notice something. If you risk 1 to make 1, in order to break even, okay, by the way, this line is the break-even line, right? So on the left, you're losing, on the right, you're winning, that's a break-even line. So if you're risking 1 to make 1, to break even, you need a 50% win rate to break even. And you must get more than a 50% win rate in order to be profitable. Make sense? But for my strategy, because I'm risking 1 to make 2 or more, notice that my break-even zone is about 35%. So as long as I get 35% win rate, I'm breaking even, which is pretty simple. Okay? And at a 50% win rate, I am profitable, very profitable. At a 60% win rate, I'm extremely profitable. Make sense? Okay? So, for example, when I showed you one of my traders early on, why was he not profitable? Because his risk to return ratio was somewhere here, right? When he was losing 1 R. But when he was winning only 0.5 R. So, it was there. And his win rate, even though his win rate was something like 50%, was about 50+%, notice he was losing money. Okay? So the idea to get profitable is two things. Number one, you have to increase your risk to return ratio and or increase your win rate. Okay? Simple as that. So how do you do that? Let's take a look right now. So if having a low win rate is your problem, what are the reasons and what can you do about it? Now, first of all, let me define what's a low win rate. Okay? Some people think, a win rate of below 70% is a low win rate. No. In trading, I can tell you that a low win rate is anything below 45% consistently. Okay? There are many very successful traders that make tremendous amount of money with a win rate of 45 to 50%. So that's fine. But if you get less than 45%, like below 40%, then you're not that profitable. So you want to always aim for at least a win rate of 45% or more. Again, 50 to 60% is fantastic. So if you get a low win rate consistently, why? Here's a very simple reason. Oftentimes it's because traders trade against the trend. That's a very common reason why you are the odds are against you. Okay, remember that if you enter the market randomly, you toss a coin, heads you go long, you buy, tails you go short, you sell. you should be right half the time, right? So if you're right less than half the time, it's because you're going against random odds, because you're going against the trend. So again, what's a trend? For example, you can see that Facebook is on a very strong uptrend. And you can read the trend by looking at the moving averages, right? I've taught this in my previous videos. When the price is above the moving averages and the moving averages are sloping up, it's a very clear uptrend. So on an uptrend, you always want to go long. You want to buy, because on an uptrend, the statistical probability is that prices will go higher. Okay, it's kind of like a river current, right? The river is flowing north, you want to swim north, right? If you swim south, highly likely you're not going to make it, okay? So the biggest mistake people make is they sell, they short the market, they sell on an uptrend. Okay, chances are you're going to get it wrong most of the time because the trend is going up. You don't sell on an uptrend. Okay, at the same time, when it's on a downtrend, what's the probability? The probability is that prices will go lower and lower, right, based on statistical odds. Okay, so the current is flowing south. You want to swim south, you want to sell, you want to short, you don't want to go long. So again, if you buy, like look at GE. GE has been on a downtrend for many months. And many people want to catch the bottom, right? So they are buying, hoping it's the bottom, right? And they're going to die because you're buying on a downtrend, chances are you're going to lose money, right? Same thing if you are selling on an uptrend, okay? Now, but some people say, Adam, on an uptrend, I buy, right? Like what you said, I buy, but I still lose money. So it could be one reason because you buy on an uptrend, but you buy when the price is overbought, when it's overstretched, right? When the price is too far from the moving average, what happens? It tends to snap back to the moving average. It's like a pendulum, right? So a lot of times when people buy on the uptrend, they buy too late. For example, they buy somewhere there, okay? They say, oh, it's going up, they buy here. And what happens after they buy? Boom, goes down and hits their stop loss over here, and they get stopped out and it moves higher. Ah, my God, you know? So you should be buying somewhere here. When it makes a dip on the uptrend, buy it when it's near the moving averages, not buy it when it's overbought, right? Here's another example where, you know, people, they say, oh, the price is going up, and they say, I'm going to buy there. What happens? Boom, it comes down. The moment they buy, hits their stop loss, they're out. Because they buy when the price is overbought. At the same time, again, on a downtrend, you want to go short. You want to sell on a downtrend, okay? And that's, but sometimes I sell on a downtrend, I still lose money, right? Because you sell when the price is oversold. Right, so for example, imagine that the price goes down here, and you say, okay, I'm going to sell. It looks like it's going down. They sell. Once they sell, what happens? Boom, it goes up. It hits their stop loss, right? Because when the price is too far from the moving average, it's oversold. It's like a rubber band, snaps back to the moving average. So when you're selling on a downtrend, you always want to sell when it's near the moving average. So you sell somewhere there. You sell somewhere here when it's bouncing off the moving average, right? So you must know when to enter at the lowest risk point, and that's what we teach in our programs. Another common mistake people make is that they buy just below a resistance level, right? So it could be on an uptrend like that, uptrend, but they did not see there's a strong resistance. So they buy, boom, here's a resistance, bam, goes down, they lose money. And say, why am I so unlucky? It's not luck, it's skill, all right? Similarly, people may short on a downtrend, but they don't realize there's a strong resistance or strong support. Support, resistance, right? So goes down, they say, okay, I'm going to do a short. They sell, goes a bit down, boom, it hits the support, bounce up, they lose money. Right? These are the typical reasons why you've got a low win rate, because you're not entering at the best time. Okay, so that's the first thing that you have to watch out for, guys. Now, another reason for low win rates is because traders tend to take low quality trades. In other words, they take trades where it's not a high probability. Okay, and a very common reason is because of impatience, right? A lot of traders, they're very impatient to take a trade, so they're trigger happy. The moment they see something that looks like a trade, even though it doesn't meet the rules, exactly, they say, okay, let's bend the rules a bit. It's okay, let's just take it, right? Or they're bored, right? And to them, trading is a way of entertainment and excitement. And I always tell people that good trading should be boring. If you're excited by your trading, that's not good. If you want excitement, go to Universal Studios, go to Dream World, go to Disneyland, right? Trading is not for excitement. Trading is for making money consistently, right? Executing trades. So if there are no trades to take on a certain day or 2 days or 3 days, don't take any trades. Only take high quality trades. So For example, you can see that, right, if you are on my trade alert service or you follow my trades, you know, I only take very high quality trades with multiple level of confluence patterns. In other words, when all the stars are aligned, I take those trades. So quality trades over quantity trades. For example, these were some of my trade alerts this month, and you can see that this was LLI, right? I sent this trade alert as well as PII. Okay, so I sent these trade alerts this month, okay, and take a look at why I send those trades. So that was the first one, PII, and the trade alert came out, let me see on which day, on this day, that's right, on the, somewhere about the 10th of November, that's right. So I took a trade here because I saw that it's on a very clear uptrend, so I wanted to go long, I wanted to buy, and you can see that over here, the price was bouncing off the moving average, bouncing off the 20 moving average, okay? So that's not only the reason why I bought. Besides bouncing off the 20 moving average, you can see that this is a Fibonacci retracement level. Okay, so this is A to B, right? That's the impulsive wave, and this is a corrective wave, which is exactly at 61.8% Fibonacci level over there, right? So in other words, this point which I entered by the way on this this candle over here. I entered on this candle, waiting for the confirmation of the bounce. So why did I enter? Because it found support at the moving average plus the Fibonacci level. So it's double confirmation, plus you can see that the stochastics over here is oversold, telling us the price is oversold, it's going to bounce up. It's on an uptrend. So this is what I call a high quality trade. When all the stars are aligned, highly likely it's going to go in my favor. Again, it's not 100%, but I just have to be right more than 45% of the time. 50% of the time, I'm making a lot of money. Okay, the next one was PLII. This was another one of my trade alerts, and you can see, again, I entered, let me see, where did I enter? I entered, I believe, on this day over here. That's right. So again, it was bouncing off the moving average. I waited for a confirmation candle to take the trade. It's bouncing off the 20 moving average support, plus it's a 61.8% Fibonacci level, plus again, stochastics is oversold. So these two trades, PII and LII, both have the same pattern, right? So when you take trades with high confluence, you get very high win rates, okay? So that's how you get a high win rate. Now, what if your problem is a low risk to return ratio? In other words, what if your average losses are bigger than your average wins? You know, what's the reason why? So again, these are common reasons why, okay? So first reason why this happens is probably you take profits too quickly. And this is a very common mistake that many traders make. So the moment they enter a trade, okay, and it makes a bit of money, they're afraid of losing that money. So quickly they say, okay, let me take that profit, take that profit. So they think there's nothing wrong with taking a profit. There is something wrong if you take profits too quickly. When you do not allow the trade to maximize its potential, you get very small wins. And when you get small wins, they are not enough to cover the losses that will come eventually. Does that make sense? Okay. Another reason is because you hold on to losing trades too long. Okay. You take profits too fast, you hold losing trades too long. And why does that happen? Well, one reason is some traders do not put a predetermined stop loss. I had someone who once told me, you know, Adam, real men do not put stop losses. Well, I can tell you he's out of business now. He's bankrupt, okay? So when you enter, you must have a fixed stop loss. So so when you do that, you predetermine how much you're going to lose when you're wrong. Okay, so again, I always limit my risk to 2% of my capital, which is an R of 2%. Okay, so always put a predetermined stop loss. Now, some people, what they do is, say it's going up, right? And they put a buy order here, and they place a stop loss somewhere here. Okay, but when it goes down, they say, I don't want it to hit my stop loss. No, I don't want to lose my all. So what do? They will say, okay, let me give it more room. They'll shift their stop loss down and say, okay, you know, give it a bit more. And it goes down. Oh my God, it's going to hit my stop loss. Shift my stop loss down again. Oh my God, it's going down, right? And eventually what happened? When it eventually hits their stop loss, instead of losing 1 hour, they lose 4 hour or 5 hour. And that one loss can wipe out many wins. Okay, so never ever shift your stop loss down if you're going long, or shift it up when you're going short. Next, one of the most common mistakes people make is to average down their losers. So not only do they not have a stop loss, but when the price is going down, what do? Right? They buy more, they buy more, they buy more to average down the price. They think they're Warren Buffett, right? Now that's what Warren Buffett does, and there's nothing wrong with that, as long as you are an investor, not a trader. There's a difference. As an investor, you're holding for the long term, you're holding for many, many years. And for investors, you only buy defensive, predictable companies. You do not buy cyclical stocks. You do not buy momentum growth stocks, right? So that's the wrong time to apply that strategy, okay? And so why do many traders do this? Why do they shift their stop loss? Why do they not have a stop loss? Why do they average down their losers? Here's the irony, because they are afraid of losing money. And in the market, the more you are afraid of losing money, the more you're afraid of taking a loss, the bigger losses you will have, and the more money you will lose. Okay, so always remember that. Never be afraid of taking a loss. To me, trading is like a business. When I have a win, it's my sales revenue in a business. When I have a losing trade, I don't feel bad. It's part of the game. A losing trade is my cost of goods sold. Okay, so when I have a win of 2 hour, right, I have a loss of 1 hour, sales minus cost, I still have a profit of 1 hour. And that's a fantastic business, right? Another reason why many traders are not profitable is because they have inconsistent risk per trade. What it means is they keep changing the risk they take for each trade. For example, they're more confident, they risk more. They are less confident, they risk less. And this always leads to inconsistent results. So I'm here to tell you something. Even if your trading system has a good win rate and your trading system has a good risk to return ratio, you can still end up losing money if you keep changing your risk per trade based on your emotions. All right. So let me give you an example of what I'm talking about. So let's imagine that there's a trading strategy with a win rate of 60%, okay, and a risk to return ratio of 1:2. Now, is that a good trading strategy? It's not bad, right? In fact, this trading strategy will make you a lot of money. But there are some people who learn this strategy but lose money. Let me explain why. Let's imagine at the beginning, they decide to risk 1% per trade, right? So they risk 1% of their capital on each trade. Now, you have to watch my video on position sizing to understand how to calculate the number of shares to buy when you risk 1% per trade, okay? So let's imagine this person starts trading and they get 5 wins in a row, right? Their first 5 trades are wins. Now, remember, every time you lose 1%. You win 2%, right? It's 1-2. So with 5 wins, they get 2%, 2%, 2%, 2%. So their total return is 10%. Now, what happens to most people after they get 5 wins in a row? That's right, their head becomes really big. They get too confident. They say, you know what? I'm fantastic. So I'm going to risk more money so I can make even more money. So what do? Right, they risk, for example, 5% a trade now because of their confidence. Okay, so they buy more shares, they risk more. But they forget that after 5 wins, guess what? Losses will come. You can't win all the time. You have wins and losses, right? And say after the 5 wins, they get 4 losses in a row. So remember, the wins come in a row, losses can come in a row. And but because now they risk 5% of their capital, what happens? Each loss is 5%. And they get 4 losses, that's a 20% loss. So what happens? They made 10%, they lost 20%, now they are down 10%. Okay? So even though they had more wins than losses, they are still losing money. Okay? And what happens after 4 losses? That's right, they lose their confidence. They, oh my God, all right, let me risk less because I'm scared. So now they go back to risking 1%. And what happens? Then the next trade becomes a win. But this time, because they risk 1%, a win is only 2%. So they make 2%. So plus 10 minus 20 plus 2 is what? Right? Is minus 8%. So after doing 10 trades, they are down 8%. But notice they had 5 plus 1, they had 6 wins and 4 losses. So the win rate is 60%. So there's nothing wrong with the win rate. The risk to return ratio is risking 1 to make 2, but they're still losing money. You understand? So traders lose money because they increase their risk per trade after a series of winning trades because of confidence, and the losses come wipe them out. Okay? or they start to reduce their risk per trade after a series of losing trades. And when the winning trades come, it's not enough to cover for the losing trades. Another reason why traders lose money is because they judge the performance of their strategy on a small sample of trades. So they may learn a good trading strategy, but for some reason when they first start trading, their first 10 trades or first 20 trades did not do as well as they expected. So what happens to them? Okay, they lose confidence, right? And so they abandon the trading system, or they find a new trading system, or they say, okay, let me not trade stocks, let me trade Forex. Let me not trade Forex, let me trade options. So they keep going around in circles, right, in search of the holy grail, a system that wins all the time, that will win in every 5 or 10 trades. It doesn't exist. That's why most traders spend all their money buying all the trading courses, reading all the books, going around in circles and never making money, because they do not stick to one strategy enough to have enough trades to make it profitable. Okay, very important. So with that, let's now summarize everything we've learned in this video. The 7 reasons why traders are not consistently profitable. Reason number 1 again, because their strategy has a low probability of winning. Their strategy has got no edge, because again, they're trading against the trend, or they're buying when it's overbought, selling when it's oversold, buying at resistance, selling at support, right? Second reason, they take low quality trades, right? They go for quantity instead of quality because they are bored and impatient. Number 3, they've got a low risk to return ratio. When they lose more, they win less. Why? Fear. Fear of taking a loss causes them to hold on to losers too long and take profits too quickly. Number 4, well, it's related. Number 4, taking profits too quickly and taking large losses, right? So that's all related. Sorry about that, right? Okay, number 6, inconsistent risk per trade. Constantly changing how much they risk, right? When they're confident, they risk more. Lose comes, they lose less. So as a result, the statistics are all out of whack. And the last reason why traders lose money is because they do not stick to a consistent trading strategy. They keep changing strategies, adding new indicators, right? Changing trading Forex to stocks, to options, and switching around and never staying with a strategy long enough to master the strategy. Okay, so I hope you understand it, guys. And with that, if you would like to watch more videos, you can subscribe to my channel. If you'd like to find out more about my online professional Forex and stock trading courses, do go to piranhaprofits.com. For our live training courses in Asia, do visit wealthacademyglobal.com. This is Adam Khoo, and may the market be with you.